Parag Jariwala is joining us. He's a research analyst with Religare Institutional Research. Parag, good morning. Good to have you with us here. Thanks very much. Just wanted your thoughts. I have your report wrapping up the second quarter earnings, and we can talk about that in a bit. But just your thoughts on the three large PSU banks, PNB, SBI and Bank of Baroda. Are you sensing any interest in those names from investors after the results?
See, I mean, the interest is very, very high when you talk about the largest bank, that is State Bank of India. I mean, the market is very, very convinced about recovery happening so far as the NPA levels are concerned. If you even look at stress asset formation, the stress asset formation, including everything where the market is currently worried about, which is like ARC sale, 525 restructuring, or you talk about strategic debt restructuring, as well as slippages and all. If you add up all these numbers also, then also I think stress asset formation is down 28% quarter on quarter, which I think market is really liking about the bank. And what we think is that the margins are somewhere at the bottom and should remain at around 3.1 kind of a level for the next 2-3 quarters. And with the cut in base rate, I think even the loan growth recovery should happen with that name. So SBI remains the top pick among PSU banks for us, and we like the stock very, very much. So far as Bank of Baroda and PNB is concerned, I think on PNB still the investor interest is not that great, but Bank of Baroda, the market is very, very excited about the new chairman coming in, his strategy. He want to revamp the bank, and a lot of changes may happen because now we have first time in the history we have private sector guy running the PSU bank. So so investor interest is very high so far as the SBI and BOB is concerned.
Actually we were talking to somebody about PNB. In PNB, if you look at the foreign holding, it's at about 13%. 3 quarters back, the holding was about 18% or so. So from that level, it's come down to about 13%. PNB is still in the FII restricted list, Parag. Right? I mean, that is essentially because the RBI has not updated the list. Because the limit was 18%, the actual ownership is 13%, but it's not out of the list. As you said, for obvious reasons and for good reason, PNB trades at a much lower multiple as compared to, say, a BOB or a SBI. And you like SBI as a top bet, BOB there's a fair bit of interest, top management change, and PNB in a way is the least liked. Because of this foreign ownership thing and because of the large valuation difference, could there be a bigger sort of delta to be had if things did start to improve even a little bit here in PNB, or not really?
See, if there is no doubt. I mean, let me say that if things recover very fast and there is a broad-based recovery, every stock in any sector which is beaten down the most will give you the best return. But we need to see whether we are seeing a broad-based recovery or whether we are actually completely out of the woods, and tomorrow loan growth will be at 20%. Slippages run rate will come down quarter after quarter, and the credit cost will start declining. Are we going to see those dates? I think we are too early to call bottom or call that we are back on the recovery path very, very smoothly. So I think there are still a lot of things which needs to be done by the government and by the banks on the ground levels. So I think still it is better to stick to good quality banks and definitely private sector banks. And if you want to pick up something among PSUs, then I think one should stick to the top 2 banks, because if you see the stress asset proportion for PNB is almost as high as around 10 to 11% of his loan book, which is even much higher than its net worth, whereas the comparable numbers for SBI and BOB is far lower. So then there is no case for to go for the bank which has NPL problems double of SBI or above, when we don't see any meaningful recovery happening at the ground level. Valuation difference is there and definitely very high, and it will stay high at least for the next maybe 2-3 quarters till you see some pickup in the economy.
Because of this entire power thing, the UDAY scheme, the reform thing, although none of these loans were sitting as NPLs, maybe restructured but not NPLs, what does this really mean? And which banks, if this works, the scheme works, and all states accept it, what's the impact going to be, and which are the stocks which will benefit?
See, if even if you assume that top 5-7 loss-making states or near loss-making states, not all of them may be in the huge debt burden, but even if you count that around 7
top
banks,
5 states
seven
account
states,
for 90% of the losses. Top 5 states account for 90% of the losses, and 3 out of those 5 states are BJP ruled states, so there should be no problem. I mean, it's only UP and maybe Tamil Nadu amongst those 5 where you need some approval. But anyway, so let's assume this works, right? So it shouldn't be a problem. For 90%, if it works, well, that's as good as any you're going to get.
Yeah.
So which banks you think would benefit the most?
Yeah, so in terms of banks, definitely the top 3 banks will not benefit much, because if you look at SBI, BOB, or even to some extent PNB, their exposures to state electricity board is hardly 1 to 3% of its overall loan book. So they're not going to benefit so much. But if you go down to your mid-tier or small PSU banks like Indian Overseas Bank, then you have Allahabad Bank or Indian Bank, Andhra Bank, all these banks have around 8 to 10% of their loan book sitting in the SEB states which are into trouble. So I think they will benefit the most in terms of their restructure proportion will go down significantly once this discoms approves the rehabilitation package. There will be some hit on the earnings though. I mean, their margins will decline because your high yielding 11-12% yielding loan book will get converted into 8-9% bonds, but the relief or the comfort on asset quality would be a big changer for all these names. We don't cover mid-tier PSU bank, but these are the reported numbers by most of the mid-tier PSU banks, where they have around anywhere between 7% to 10% of their exposures to SEB. They will benefit the most.
Yeah. Do you cover REC PFC, Parag?
Yeah, we do cover REC PFC. So see, the point for REC PFC is that let's say for example REC 33 or close to 35% of the loan book is been given to the discoms which are a part of 5 big states as you mentioned. If that entire loan book gets converted into debt, then your hit on your margins would be very, very substantial. And so far as the REC PFC concerned, they haven't restructured any of the discom debt. So comfort on asset quality or the relief on the asset quality is only sentiment driven. It's not there somewhere in the numbers. And the impact on the P&L because of the lower margins would be very significant. So we think that they will lose out once this discom rehabilitation package has been approved by 3, 4 or 5 states, and I think both the stocks are covered at this level, because see, the business case for them to exist in the market vanishes completely. I mean, no lending institution in India can borrow from the open market and lend to state governments. I mean, that would be, if the state government is in a good shape, that is a negative carry business. And even if it is a positive carry business, you hardly earn, 0.5 or 1% spread, where at that spread, there is no business sense to remain in the lending space. They can benefit in the longer term if there is a, sharp pickup in the distribution or transmission capex. But that is, I think, at least maybe 3, 4, 5 years away, I don't know. So I think best way is to stay away from both the names.
If you own REC PFC, I mean, then you should sell. I mean, if you're saying there is no real business case left now for these names, then you should sell. Then you should get out if you own these stocks, right?
See, it's there, but the point is that both the stocks are trading at maybe 0.6 or 0.7 price to book. If you kind of knock out 30% of your book from your balance sheet, and rest of the book is actually very healthy in terms of asset quality, and you have some reasonable kind of assumption about the growth resuming in the transmission and distribution space, then probably you can make decent money over a longer period of time, not immediately.
I'm not sure which one, Parag, but I think
for things, how government looks at the sector.
Yeah, no, I mean, actually you said 30% of the book, but I think for one of the two names, the exposure to SEBs is as high as, I think, about 60% or so, 50-60%.
So there is no restructuring so far as the generation is concerned. There is only conversion of debt into equity for discoms. And as you said, that not all discoms will kind of convert their loan into equity. Loan into maybe a state government bonds. Only top 5 states which are loss making. See, I agree that top 5 states account for 90% of losses, but top 5 states doesn't account for 90% of the debt. That would be far lower in overall proportion. So if you do that number, see, I mean, it's our working that around 35-40% of the books may get converted into state government bonds. It can be even a slightly higher number. The case is that whether at 0.7 times price to book, do you just go out and sell the stock, or probably we want to hold it on for maybe a possible recovery in the transmission and distribution capex going forward. I think we have a hold rating on both the stocks, so we will say we'll kind of remain neutral as there is a head because of the margins getting eroded, and there is a case for a growth because your distribution and capex cycle may begin in the power sector. So so I think we will kind of stay neutral on because of these two events.
All right, thanks very much, Parag. Good speaking with you. I wanted to get your views in on SKS as well. You have a negative view, non-consensus view. It's always interesting to discuss those, but I'm out of time, so maybe next time. Thank you.